The big Canadian banks are reporting this week. Royal and National releasing their reports ahead of the trading day. Let's dig in the numbers with Kyle Taylor. He's wealth advisor and portfolio manager at TriDelta Private Wealth. Thanks for joining us today.
Thank you.
Solid earnings from both of the banks, but let's start with Royal, which reported $5.4 billion in profit for its latest quarter. Capital markets doing well. And Kyle, that's really no surprise.
Yeah, I can't say we were expecting any surprises, significantly for RBC or any of the banks this week. I think it's good for the TSX, generally speaking, that we're not seeing any surprises. But one of the things that we were watching pretty much across the board was really just any comments around provisions for credit losses. You may remember that earlier in the year, and due to tariffs, they increased provisions for credit losses kind of across the board. RBC was no different. And then, as they saw that loans were continuing to perform, they reduced those provisions, which saw a lot of momentum for the financial stocks, sort of driving up for most of the year. And now we're starting to see those provisionings creep higher. And I don't think that's really any surprise given some of the economic data and genuine fears for the consumer.
Okay, so talk to me about wealth management being strong for both banks. Royal, we'll start there.
Well, I can't say it comes as much surprise for RBC. They were up 33% year over year. As that asset base expands and they continue to take on more Canadians as clients, they're going to generate more fees in that respect. But I think just as quickly as that can happen in a good year like 2025, who knows what 2026 has ahead in terms of how market performance and what they're going to see in that particular segment.
The CEO is giving a conservative push for the forecast. Do you think he needs to be or err on the side of caution at this point?
I certainly do. I think that it's no secret that everyone's sort of a little bit more cautious headed into 2026. Broadly speaking, even just outside of the banks, I think 2025 has been one of the most hated rallies in recent memory that we can really point to, and we're seeing the same comments come out from CEOs and not just the banks, but broadly speaking as well.
All right, let's get to National. Strength in the same unit, capital markets, wealth management. But how has it managed its Western acquisition? How's that going?
Well, expenses, no doubt, were increased. I believe it was about 21%, and that offset some of the profitability that they saw in other segments. But I think generally speaking, it's been a good integration. I think it helps them increase their market share and also gain a bit more of a foothold outside of Quebec. And then, of course, we had the big news earlier this week with Laurentian Bank and Fairstone, and the deals being split between Fairstone and National Bank, and National Bank taking the deposits in some of the SME loans. That should be accretive to return on equity by, I think we estimate by about 2%. Generally speaking, though, I think we see National Bank as pretty fairly valued today in and around the high 160s, low 170s. And there's kind of limited room for upside on them. But again, there could be some surprises in respect to the integration of Laurentian Bank and further increase in market share from CWB.
What do you expect from that integration? I don't think National will oversee the closures of the banks in Quebec.
I think it incrementally strengthens their presence in Quebec, which is, of course, their core market. And it seems that, especially in particular yesterday, it was generally well received. Today, I think we're seeing a little bit of a normalization. Earnings really weren't a surprise, and maybe investors felt that the stock got a little high yesterday, and we're seeing a bit of a pullback today.
Okay, let me ask you about the banks and what we've seen so far in reporting, and whether you think it paints a fair picture of what the Canadian economy looks like today.
That's the question, right? It's interesting because, of course, the banks seem to be trading at a premium in the face of significant economic weakness. I really fail to see how the banks can make a material move higher into 2026, but that doesn't mean that earnings can't catch up to multiples if the economy and consumer prove resilient into 2026, 2027. 2026 is another big year for mortgage renewals for Canadians, which will be of acute focus. There's a lot of things on the macro as well, the USMCA renegotiation with Canada, the US, and Mexico that could shift outlooks pretty dramatically. And then, generally speaking, though, I think if we only see a marginal decrease in interest rates from the Bank of Canada in 2026, that still leaves plenty of room for profitability from the banks. I think where the outlook takes a dramatic shift is if we see a swing to that one way or the other in interest rates and how some of the implications for that more broadly.
Do you feel like the lack of a trade deal or a renegotiation on the trade deal is a big overhang for the banks?
I think it's a big overhang for everybody, not just the banks. I think the TSX in general. The one aspect that I can maybe be proven wrong a little bit on the TSX and the bank stocks is if we start to see as a Canadian market, if we start to see a bit more of the incremental fund flows from international investors. It's no secret that we're seeing a bit of a rotation out of US dollar assets and away from that expensive market to other regions. I mean, Canada is a significantly smaller market than the U.S., and if we saw even 0.5% of those fund flows, that can move the needle in Canada, and the banks being a significant portion of our index, that can help push things quite a bit higher and stretch multiples even further.
Kyle Taylor, I'm going to leave it there. I'm out of time. Thanks for your time. Appreciate it.